The Food and Agricultural Policy Research Institute at the University of Missouri said this week average payments for ARC and PLC programs under the 5-year Farm Bill will peak with the 2015 crop at about $6.5 billion. The institute expects the federal government to pay out $3.9 billion for last year's crop. The deadline for U.S. farmers to choose between ARC and PLC is March 31st. Earlier this week, we took a final look at that decision with Nebraska Extension Public Policy Specialist Brad Lubben. Producers were initially supposed to update base acres and yield by February 27th, but as Brad said when we talked, that has now been changed to the end of March.
Base and yield were originally due by the end of February, but as that deadline approached, the USDA pushed that back to March 31st. Now that puts everything on the same line: base decisions, yield decisions, and eventually the ARC versus PLC decision all this month.
As NASA updated its county yields for 2014, how did that affect the decisions that producers need to make or are thinking about making?
Well, remembering that producers are making decisions about ARC versus PLC based on 2014 through 2018. Now NASA's published the county yields for 2014, and those county yields affect revenue, which affects potential payments under ARC. The yields came in a little bit above average. We knew it was expected to be above average, but the non-irrigated yields particularly were rather high above average. That translates into higher yields, higher revenues, smaller ARC payments. That might change that ARC versus PLC analysis that some producers had figured out.
And the analysis of price over the next 5 years, trying to determine where prices are going to go for each single commodity. How should a producer determine or make that analysis of where he or she believes that price is going to go?
Well, it's clearly a difficult decision. As I noted, 2014 through 2018. You really do have to sort of crystal ball this to have some confidence in what's going to happen with price to translate into what program is going to protect you more. But the analysis also has to carefully acknowledge what you think is going to happen versus sort of the uncertainty of that. For example, corn, the trigger price is $3.70. If we know that the market price is going to be above $3.70, we can calculate that the PLC payment is going to be exactly zero, and the ARC versus PLC decision becomes pretty simple. But if we think price is going to be above $3.70, but we're uncertain about that, then you got to worry about both the fact that it might be higher, it might be lower. If it's lower, suddenly we do have PLC payments, and that ARC versus PLC decision becomes more complicated. If I know exactly what's going to happen, I can figure out this program in a spreadsheet very easily. If I think I have an idea of what's going to happen, but I worry about all that uncertainty between now and 2018, it's worth looking at all the scenarios, the analysis like the online decision tools provide.
Let's talk about each commodity specifically. In corn, is there a clear winner?
Corn, if you look at it purely on expected numbers and we hit those numbers, you'd expect ARC to come out on top. Now, higher yields in 2014 on the non-irrigated side are going to pull some of those ARC payments down, but ARC still wins as long as you know what's going to happen. As soon as you think about the uncertainty in price, as soon as you think about potential bearish scenarios, as soon as you put some value on the supplemental coverage option, PLC gains ground, and in some cases PLC probably wins that analysis.
Soybeans?
Soybeans is sort of the converse. All of the analysis, even the uncertainty, still seems to suggest that ARC wins in almost every case because we're far enough above that 840 trigger level for PLC payments that we really don't project getting there very much. Now, it's not a pure answer, but it certainly seems like ARC dominates the analysis.
And what about wheat?
And wheat, it's one of those, if you know exactly what's going to happen, ARC wins the calculation slightly, but just as soon as you plug in some uncertainty, the more uncertainty you have, the more downside you have, the bigger PLC payments get. It seems like PLC wins most of the analysis.
And finally, the last one, sorghum?
And the same way for grain sorghum. The more downside risk you look and worry about, the more PLC wins. Grain sorghum, in fact, pays out bigger on PLC than corn does, both feed grains. But grain sorghum has a higher reference price, and if the markets are true to history, a slightly lower market price, which would translate into bigger PLC payments.
As Brad said, the choice between ARC and PLC depends largely on your expectations of price. The decisions Brad mentioned in each commodity are illustrated in a recent Cornhusker Economics article with associated price analysis. We'll link to that information on the Market Journal homepage.